You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Bupp has spent 14 years successfully making it happen. This is the Real Estate Investing for Cashflow podcast. Now, here's Kevin Bupp.
Hey guys, Kevin Bupp here, and I want to welcome you to another episode of the Real Estate Investing for Cashflow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. And our guest for this week's show is real estate investment expert and repeat offender to the Real Estate Investing for Cashflow podcast, Bryan Murray. Bryan acquired his first investment property in 2007. Without raising any outside capital, Bryan bootstrapped his way from newbie investor to founder and CEO of Washington Street Properties, a commercial real estate investment and property management company that has been ranked on the Inc. 500 and 5,000 list of the nation's fastest growing private companies for 5 years in a row. In 2015, Bryan was recognized with a Gold Stevie Award for Executive of the Year in the real estate industry. Bryan is also the author of the best-selling and award-winning book, Crushing It in Apartments and Commercial Real Estate, which sold more than 20,000 copies in its first year of publication. And I'll tell you guys, I've read it. It's definitely a must read for those of you that are looking to get started in the commercial real estate space. Okay, it's got a lot of great information. It's a thick book. I think it's probably 400 plus pages. So lots of good information there. No fluff whatsoever. I definitely recommend it. In addition to Bryan's real estate endeavors, Bryan also has worked as a teacher, a technology executive, management consultant, and engineer. His media appearances include interviews on CNN, PBS, CBS Market Watch, and Bryan has been also quoted by the Wall Street Journal, the New York Times, and dozens of other major newspapers around the world. He holds degrees from Syracuse University, Johns Hopkins University, and the Darden School of Business at the University of Virginia. And so there's a litany of topics that I'm looking forward to covering with Bryan in today's show. And if you haven't listened to it already, go back and listen to our first show that we did together, episode number 135. I think you'll find a lot of value in both that show as well as this current one. And so a few of the topics I'd like to cover today are details on how Bryan repurposed an old hotel into a thriving apartment complex. That's a very unique and interesting business model we're going to dive into today. What his favorite asset type is and why. How he manages to spread his focus amongst numerous different asset types versus just focusing on one. Like, for example, our business is mobile home parks. I mean, that's what we focus in. Not that I haven't owned other types, but today we focus solely on mobile home parks. Bryan has a litany of different types of assets that he is involved in. We're going to talk to Bryan about how he feels about local investing versus owning and operating assets outside of his geographical investment area. Also talk to him about how he's finding great opportunities, even in today's, I call them challenging times, because everyone's chasing yield. People are paying, exorbitant prices for properties, and Bryan is still uncovering great deals, and it's happening on a regular basis. Additionally, we're going to talk about the mistakes he's made along the way and what lessons that he's taken away from them, and much, much more, guys. So I'm excited to have another candid conversation with Bryan about just, again, a variety of topics. And I'm absolutely confident that you guys are going to find huge value in this time together. And so with that, a few items I want to cover before we get on to the show with Bryan. First and foremost, if this is the first time that you're tuning into the show, I just want to welcome you to our family here at the Real Estate Investing for Cashflow podcast. Or if you're one of the many millions of loyal listeners that listen to the show on a weekly or monthly basis, whatever have you, I just want to welcome you back and thank you all from the bottom of my heart for being here. I wouldn't be here. The show wouldn't be around if it wasn't for you. And since it's really loyal listeners like yourself that make it all possible, I'd like to take a moment and give a shout out to one very awesome person who took the time to leave a 5-star rating on iTunes. And this is from Josh. It says, I have been a listener of Kevin Bupp's podcast for a while now, and they have been monumental in my journey of learning about real estate investing. He brings on industry experts and is the best free learning resource that I have found in the industry. Keep the podcast coming. Well, Josh, really appreciate that. Appreciate taking the time to go there. And guys, if you love what we're doing here, it only takes a minute. And really, these reviews drive our overall growth of the podcast. It attracts guys like Bryan. Bryan looks on there and he sees that we got, no reviews. He's going to think no one's listening. That's not the case. So it helps us attract quality guests like Bryan. Take a minute, go subscribe to the show. And if you're so inclined, leave us an honest rating, and review. And I'll be sure to give you a shout out on an upcoming episode. And just a few other items real quick before we get on here. Just want to remind you about the free 30-minute phone consultation that I just started offering again after about a 1-year hiatus, where you can basically get on the phone with me, no ulterior motive whatsoever, for 30 minutes and discuss anything and everything your heart desires about real estate investing, whether you're brand new or you're a seasoned investor and just want to talk shop. Again, this is a way for me to connect with the listeners and give back in many different ways. This is a way for you and I to literally connect together and talk about your business and see if I can maybe give you some positive guidance on how to ultimately reach your goals. How you want to schedule that call is go to kevinbupp.com, scroll down about 3/4 of the way to a button that says schedule a call with Kevin, and just be sure you schedule that call. Put in notes about exactly what you'd like to talk about, okay? Make sure that our 30 minutes together is done or spent as efficiently as possible. So put some details in there about the questions or the topic you'd like to discuss. Lastly, guys, we're hiring here at Sunrise Capital Investors. If you have an interest in the different career opportunities that we have available here in the Tampa Bay location, you can go to careers.sunrisecapitalinvestors.com. We've got multiple positions we're looking to fill. We'd love to join an awesome team here. And if you're a rock star yourself, we'd love to hear from you. Again, careers.sunrisecapitalinvestors.com. And now, without further ado, I'd like to welcome back our guest for today's show, Bryan Murray. Bryan, how's it going, my friend?
Great. Really excited to be here, Kevin. Thanks so much for having me back. It's an honor.
Yeah, thank you. Thank you for taking time out of your day. I know you're busy. Every time I talk to you, I saw you, I guess, about probably 6 months ago at a mastermind that we're both a part of. And, prior to that, it had been over a year since we had last chatted. And you're continually growing, buying more properties. Your company's growing. You've just got a lot of great things happening. So I'm excited to have you back here. I know you're busy, but you're excited to have you back to just really get an update from you as to what's been going on over the last couple of years. And, there's some specific topics I'd like to cover with you as well. But for those that haven't listened to the prior show we did together and don't know about you, or maybe haven't read your book and don't know your story, maybe just take a few minutes and give us a little bit of a background of yourself and ultimately how you got into real estate.
Yeah, sure. Glad to. I started real estate investing back in 2007. And one of the things that was unique is, without having any prior investing experience, I jumped right in with both feet and purchased a 50,000 square foot office building. So that's the short story.
Both feet in the fire, right?
Yeah. And, I was teaching at the time and having a little trouble making ends meet and looking for some extra cash flow. And I'd always been interested in real estate. So I did a lot of quick education. And again, long story short, I ended up jumping into a really large property and tackling it, and spent the next couple of years turning that ship around.
That's fantastic. And so that's led you up to where we're at today. So that's been, you said 2007? So
yeah, 12 years
that you've been at this. Okay, good deal. So you bought that 50,000 square foot office building. I know we went into detail in the last show. So guys, go listen to 135. We actually go into detail about that acquisition, that first deal. That's a huge deal. That's a game changer for most folks, and especially if you're working a full-time job as a teacher. To step into a project that large as your first deal that's monumental in and of itself. So go listen to that show. We're not going to talk about that too much here today because I don't want to be redundant. And so what I'd love to, talk to you about first, Bryan, is maybe just get a general update as to, if there's been any major changes in your business, maybe the direction that you're taking your company from when we spoke last time to today. Again, we're in a multifamily mastermind together. I know that you've always been in the multifamily space and you've owned other types of real estate as well. But I'm wondering now, are you starting to put more emphasis on one asset over another? But so maybe give us a little bit of an update as to what's been going on over the last couple of years.
Yeah, absolutely. So that first acquisition kind of set the tone in terms of how I developed my company, and it's really based on value add. So it was an easy transition from commercial into multifamily, and we grew in both sides. And a couple of years ago, my portfolio was about 50-50, commercial being office and retail primarily, and about 50% multifamily. And over the last couple of years, since I was on your show last, we've really started to focus more on the multifamily side. We're probably, I'd say at this point, 65 to 70% of our portfolio is in multifamily. Some of the challenges for us that we faced is, I grew our entire portfolio all within close driving distance of where I live and our main office. And that's been a very successful approach for us. There's a lot of advantages to that, but I've kind of got all my eggs in one basket in that respect. So we've begun to expand just a little bit geographically. We've continued to push into multifamily. And I've got the same concerns that a lot of investors do that are out there looking at the valuations right now. And so really over the last 6 to 8 months, we've been trying to get ourselves in a better position just in case something doesn't go the way we hope it does. So we've been doing some refinancings. We sold a few of our smaller properties, continue to push into multifamily. It's been an increasing challenge to grow our company at the same incredibly fast rate that we did all along. So I've actually begun to look at syndication as a possible way to move forward. It's one thing that I think sets us apart from a lot of investors out there is we've managed to grow our portfolio without raising any outside capital. And we do that primarily through value add. We'll increase the income and drive those expenses down and create value. And then we can go out and refi and pull some cash out and grow. But that's becoming more of a challenge now.
Okay, very interesting. You hit on a lot of different things there. So I'm going to try to dissect the last couple of minutes. And I guess first and foremost, let's talk about expanding your geographical horizons. I know that you had some, I guess I wouldn't say challenges, but you were somewhat opposed to it last time we talked. Like you were doing really well in your local marketplace. There seemed to be enough opportunity to keep you guys busy and to, ultimately, reach your growth goals, at least at that point in time. Now you're, kind of expanding your horizons a little bit. Talk to me a little bit about getting over that hump. I know a lot of people have that hurdle, more so a wall than anything. There's fear. There's lots of challenges in their mind associated with buying out of area versus being able to see that property on a daily basis. I've got my kind of explanation behind it, but I'd love to hear it from your side, like how you ultimately made it through that hurdle and are getting more comfortable with owning outside of your immediate marketplace.
Absolutely. And I can't say we've completely climbed over that wall yet, but we've just had such great advantages being local. We have these huge economies of scale. We're able to manage so many properties out of one office and share staff that even though we're not in a high growth marketplace, and it's not necessarily a marketplace that most people would get excited about, we've been able to do well. And that's part of it, is being local and hands-on and so recognizing the reality that, hey, we've kind of maybe reached our saturation point in our own market. We've got this risk. We just decided that, hey, it's the right thing to do. So over the last couple of years, each property has been just a little bit further outside of, but we still have all our properties within an hour's drive of our office. And we just put one under contract just within the last couple of weeks. That's a 2-hour drive from the office. So, but as we move, it's very interesting because we have to reevaluate how we staff these properties, how we manage these processes. And so it's not an accident that we're doing it incrementally, because it necessitates that we change our processes and how we operate on a day-to-day basis and how we staff properties. So one of our
handle all the management in-house, just to get that out there. Okay, got it.
That's right. We do handle it all ourselves. And it was, within the last few months, we picked up a 126 unit property that's just a far enough drive out away from our office that we really had to, and it was large enough, it really demanded that it be staffed on site. And so we're working through just making sure we've got these processes. And it's very interesting because as we look further outside of our marketplace, we realize that, hey, the process to manage something that's an hour away really isn't that different than if it were, say, a 2-hour plane ride away. So, that's something that's underway right now. And I remain a huge proponent of buying locally if you can do it. I just think that you can manage so many risks that way. There's so many advantages. I do cover those in my book, but just no one will ever manage your property quite the way that you would yourself. And there's no substitute for stopping by in person to see what's going on. So, but that said, sometimes it's just not feasible. And sometimes there's other things that draw you to other markets and that may be much more attractive from an investment standpoint. And you just have to recognize that you're trading off there. There's pros and cons and you're getting some advantages and some disadvantages.
Got it. No, that's a great point. All good points. Let's talk about the shift that you've made from, maybe 50-50, you said 50% commercial real estate, which would be office and retail, 50% multifamily. That's what your holdings look like 2 years ago. And you said that's more started pushing, higher towards the multifamily side. So now you're maybe at like I forget what you mentioned there, maybe 40% commercial retail and 60% multifamily, or maybe even higher than that multifamily. Yep. But I guess, what is the reasoning behind that shift? And ultimately, if you're looking to, maybe buy outside of your immediate marketplace in the multifamily space, are you still open to and aggressively looking at commercial opportunities, or are you just really you liking the residential space much better than the commercial?
I think we've had experienced advantages both with commercial and multifamily. They both, again, they've got their pros and their cons. I think overall, I've just really enjoyed doing the multifamily probably a little bit more. I feel like you've got a lot more control over your income with the multifamily. When you're managing a commercial property, it depends on the specific property, but many, many times you have a disproportionate amount of rent coming in from individual tenants. So if you lose a tenant in a commercial property, depending on the specific property, you may lose 10% of your rent, or you may lose 100% of your rent, or you may lose 50% or 60%. And that's a challenge, never knowing when that's coming. And as people have seen with all the closings across the country, especially in retail, sometimes you have a seemingly stable, solid company that's a national tenant that 2 years later, you just don't know what's going to happen.
Sure.
And you don't really have a whole lot of control over that as a landlord. And when a space vacates and you don't have that cash flow to cover your debt, you got to be prepared to carry that. You can contrast that to multifamily, and you can lose one tenant, you might lose a couple percent of rent. So,
have you had that personal experience in the office or retail properties that you've owned, to where maybe not catastrophic, like you can't service your debt, but you had an unexpected departure of one of the tenants that made up a disproportionate amount, whether it be 10 or 20 or even higher percentage? Has that occurred? And ultimately, if so, how have you handled that?
It has, and I was really fortunate that it didn't happen early on. And I try to find commercial properties that have that diversification among the rent, because it does happen. It does make you nervous. So, but, I'm thinking of one plaza in particular where our largest tenant occupied 40% of the space, and they vacated. It took us about 2 years to backfill that space. And a lot of times, and we operated at a cash flow negative for that entire time. A lot of times it's not as easy with commercial as well to control occupancy through rent. So what I mean by that is, with multifamily, if your occupancy is dropping, you'll often see a pretty immediate response from the market when you adjust your rents. Mm-hmm. When you adjust rent on a commercial space, it might not do anything at all. It has other factors that play into it. It has to be the appropriate space for that business model and what a specific type of business is looking for. And so it can be harder to backfill that space. And you can't just do, if you throw concessions out there like you can with multifamily, or you tweak your rents, you don't see as immediate of a response.
Mm-hmm. Is it safe to assume, if I had to ask you what your favorite asset class is, and I know that they all have their pros and cons, but is it multifamily? Is that where we're leaning at this point in time? If you had to answer that question with an absolute answer. Hey guys, Kevin Bupp here with Sunrise Capital Investors. As you are hopefully already well aware, if you've been a listener for any period of time, my goal has always been to provide you with as much value as I possibly can through my two podcasts, Real Estate Investing for Cashflow and the Mobile Home Park Investing Podcast. As our audience continues to grow, literally, we've been downloaded millions of times by folks in over 125 countries. I've had thousands of people reach out looking to get involved in our niche. And that's the phenomenal niche of mobile home park investing. For those that don't know, I've been a full-time real estate investor for nearly 20 years now, and I've personally invested in and have owned apartment complexes, various commercial properties, hundreds of single-family rentals, and I've interviewed some of the most successful investors in just about every other asset class, and I've arrived at this one very simple conclusion. Mobile home parks are hands down the best investment I've found to date. Why? They provide investors with the best risk-adjusted returns out of any other real estate sector that I've seen. Investing in real estate can get complicated, and I really want to simplify this process for you. If you're someone who wants to diversify away from the uncertainty of Wall Street and allocate a percentage of your real estate portfolio to mobile home parks, but maybe you don't have the time nor the inclination to personally locate good deals yourself, then our team will do it for you. At Sunrise Capital Investors, our team specializes in the acquisitions and management of undervalued and highly profitable mobile home parks. And we are now providing accredited investors with an opportunity to participate directly alongside our team in our up-and-coming deals. And let me say this, I believe that we are hands down the best in our space at sourcing highly profitable off-market deals. That's really what makes us unique in this niche and as investment managers. As stewards of your capital, we truly are aligned with our investors. We've structured our investment fund so that we as a company are incentivized in the same way the investor is, which is through the performance of the investment itself. In addition, we want to make sure that we not only make money for our investors, but that they understand how it's being made. That's why we provide our accredited partners with a private monthly podcast that walks them through the detailed updates on how their investment is performing. And we're very transparent, providing you with the good, the bad, and the ugly at times. And so if you'd like to learn more about the partnership opportunities with our team here at Sunrise, please go visit sunrisecapitalinvestors.com and click on the investors link to get signed up. It's absolutely free and you'll get placed on the priority list of when new opportunities come along. Also, feel free to call us at 833-CASHFLOW without the O. Again, that's 833-CASHFLOW without the O. And one of our investor relations team members will help you schedule an appointment to speak with one of our managing principals. If you have questions, go ahead and schedule a call and let's get on the phone and talk. And with that, guys, I like to leave with one last thought. From the time that I wake up in the morning till the time that I lay my head down the rest of the evening, my number one priority with everything I do, whether it be recording this podcast, working for our investors, helping each of you reach your investment goals, to providing a great experience to each of our residents who reside in our communities, is to add huge amounts of value to everyone that I come in contact with. Now, with that being said, I look forward to the opportunity of bringing value to you through Sunrise and through this podcast. Thank you for your time. Now, let's go ahead and get back to the show.
Yes, it is. Yes, it is. Frankly, there's another aspect that people don't talk about too much. And it's really interesting. The people that don't have a lot of experience in the commercial space will oftentimes believe that a commercial tenant is easier to work with. And in my experience, I actually prefer to work with the residential tenants more than the commercial tenants, especially some professional tenants, doctors and attorneys. And some of these people can be exceptionally demanding and not necessarily particularly reasonable at times, and that can be a challenge. And with our residential tenants, we have primarily workforce housing type tenants, and they're people who are down to earth. And frankly, I've been more comfortable dealing with them.
Got it. No, it makes sense. I want to talk a little bit about a project that we might have touched on in the very first time that we interviewed you, but I don't think we went into depth. And you brought it back to my attention, I guess about 6 or 7 months ago when we met at that mastermind group. And it was about an older interior quarter hotel that you essentially purchased. And I can't remember the vacancy. You can give us all the details, but you converted it into an apartment complex. So you repurposed it into a higher and better use and have been doing quite well with that investment. So I'd love to, that's an intriguing strategy. Every single one of us listening here, has driven through a town or a city. It could be the place you actually live, or it could be, during your travels, you see motels or hotels that are vacant or just, not the greatest of shape. And that might be a great location, very close to the interstate. A lot of them are, could be in a growing area, but not necessarily a demand for whatever the type of product was that was being offered, and could have a higher and better use. And so let's talk a little bit about that project, Bryan. I guess first and foremost, how you found it, and then what told you inside, like, hey, this has got a higher and better use? This surely would have a huge demand for as an apartment. Talk to me about that process you went through on deciding and pursuing that particular investment.
Yeah, in today's market, that's the exact kind of thing you've got to look for is ways to add value, and a change in use is right up there. And really, in terms of thinking back to how it caught my eye and what made me recognize that, it gets right back to that advantage of investing locally. Because it was a local property and I knew the brokers, I knew that the property was in distress. I was familiar with the new construction that had gone in that had put this property in distress. I recognized that there was a shortage in our market of studio apartments and smaller apartment options. There was a lot more 2-bedroom, 3-bedroom units, but I knew that there was an unmet demand there for the smaller units. So it all kind of just lined up and made it look like something that made sense. The project was very successful for us, and I think we would consider doing a conversion again, but we did learn a lot. And so probably the one thing to be aware of if you're going to go in and do a conversion like that is that you're changing the use of a property. And when you do that, that can trigger a lot of code requirements. Mm-hmm. So in our marketplace and in a lot of jurisdictions, that change in use would actually trigger requirements that would be the same as if you were going to construct new. Mm. So one of the things you want to look for, it's certainly much better if you have newer construction hotel that you want to convert than if it were an older property, because it's much more likely to have some of the things that you would require, such as a sprinkler system. This particular hotel had a large addition in the 1990s that was sprinklered. So we did have to add sprinklers, but we only had to add it to about 30 to 40% of the building. Mm. ADA requirements came in. We had to, and I hated to have to do this, but we had to tear out a lot of perfectly good bathrooms and build them from scratch so that they were compliant with current ADA standards. We even had to take out some old ADA bathrooms because the spacings weren't up to current code. Hmm. So some of those things you want to, if you're looking for a hotel, you want to recognize that, you're going to be brought up to code. There's costs associated with that. You don't necessarily want to find a hotel that has large common spaces. So we didn't have conference rooms or restaurant or anything else that was peripheral to the rooms themselves. Kept our conversion costs lower, very efficient. We had one small common area that we converted into a laundry room. We had an office that was being used by the prior owners that we converted into another unit. And so it was a very, very efficient process. And we had to add kitchenettes. So certainly if you identify a hotel that already has the kitchenettes in place, mm-hmm. That's a huge help because the plumbing is there and that can be a big cost. You've got to look at what walls have plumbing. If you do have to add a kitchenette, is that going to work out well? And oftentimes the traditional layout of a hotel room does lend itself to adding a kitchenette. And so that, that's not a deal breaker if you don't have them.
Mm-hmm. Very interesting.
The size is important. You'd want to check your code for your state building code in terms of the minimum square footage size for either a studio or one bedroom. If you don't meet that, you might need to combine adjacent rooms. We did combine some of the rooms and turn them into one bedrooms, where the first original hotel room became the living room area and the kitchen, and then the adjacent room became the bedroom.
Did you find the ones that you combined, did you find that, the demand was higher for those one bedroom units versus studio? Or if you can go back in time, would you just kept them all as studio units?
I would have definitely preferred to keep them all. And actually, the primary driver behind combining them was that some of the units were shy of the required minimum square footage for the size. And we ended up sort of negotiating an agreement to combine a certain number of units in there to get the square footage.
Got it. Very interesting.
The rent per square foot was definitely way higher on the smaller units. And that's generally the case for most multifamily properties. If you look at the price that people pay per square foot in the unit, in our experience, it's generally the smaller the unit, the higher the dollars per square foot. Mm-hmm. And there was a study done on the rents not that long ago in our marketplace. And even though this converted hotel is by no means a fancy apartment building, it actually has the highest dollar per square foot rent in the entire city. It's a class, C plus property. And it's getting more rent per square foot than a class A.
Love it.
Class A building.
I'm assuming, being that it was originally built as a hotel, that the utilities, you don't have individually billed water and sewer, individually billed electricity, because it wasn't built for that particular purpose. So is it just all inclusive, whatever that rent is on a monthly basis, that's all inclusive of electricity, water, sewer, trash, everything?
Right now it is, yeah. It's all inclusive, and that really appeals to the demographic that these type of units are really going to attract. It's very much workforce housing. It's very much people who want to rent their very first place after moving out of their home with their parents, or getting their first jobs, or restaurant workers and retail workers. It's a good fit.
How do you monitor abuse of utilities? I mean, I guess the unit's fairly small. So do you have issues with like folks abusing their, the heating, like they got the darn windows open and it's the middle of winter and they've got the heat blasting, or, they're excessively using the water? I've always found that to be the challenge with different properties that we've owned over the years, whether it be apartments or even in mobile home parks. When we purchase it, it's the arrangements, all the utilities, at least the water and sewers included. I've never owned anything, I don't think, where the electricity was included, but I could see where abuse would come into play fairly quickly and ultimately have a negative impact on your bottom line. So how do you guys manage that?
I think we've just been really fortunate. We have not had any cases like that, at least not at this property. I mean, we have at others, and generally we try to keep a close eye on things. Again, that's one of the advantages of being local. We can make sure a property gets walked every day and that there's not something at least that's obvious in terms of abuse. But, oftentimes it ends up showing up on a bill or something that a lot of times elapsed until it can be addressed. And, but I think that can happen just about anywhere. So Yeah, got it. After Bryan and I spoke about this particular project a little bit more in depth at Mastermind we were at a few months back, and I got to researching just to see how much information was out there on, this strategic, I guess, process of repurposing older motels and hotels into apartment properties. And there just happens to be, there's a gentleman or a company, I guess you could say, here in the Tampa Bay area that he's got a number of units, and most of the ones that he converted were older, like motel type properties. So even an older vintage than, the interior corridor that Bryan had converted. He had converted, I think, 10 or more in the Tampa Bay area. And then also he went to Orlando, which was about an hour and a half away. I think maybe about 20 or 30 properties in total, but that's his niche. That's who he services, is, that class of folks that they're looking for studio apartments, they're looking for affordable option, a little easier if it's all inclusive of all the utilities being there. And I'm not sure if he does well or not. I'm assuming that it has to make sense if he keeps redeveloping these things. And they're not in the best parts of town, but most of them, it seems that they're on the edge of progress. I know the Tampa Bay market really well, and most of the things that he owns are areas that probably are a little sketchy today, but ultimately the growth is pushing in that direction and will be there in maybe 5 to 7 years. So he's like right on the outskirts of it. And, for him, it could be a covered land play to where his piece of property is worth much more 5, 7, or 10 years from now. And during that period of time, up until then, he's going to cash flow. He's got a good cash flowing investment property. So we all know that affordable housing is in major demand here in this country, and those types of projects are in high demand. And so if you guys have an interest in this conversion process, do yourself a favor, go Google it. I mean, you'll find, I found multiple articles of folks that have successfully done this across the country, just like Bryan has. And it could be another opportunity for you. But as Bryan had mentioned in the beginning, it's just really all about keeping your eyes open, trying to see an opportunity where the majority don't. Right? Most other people would just probably had driven past that hotel that Bryan bought and probably driven past it a ton of different times. Probably some very successful real estate entrepreneurs there locally, developers that just continue to drive past it. Bryan saw something that everyone else didn't, right? Like, how can you remove yourself from your own body and really try to take a completely different perspective and see where there might be a problem that you ultimately can come up with a solution for? So, no, I appreciate you sharing all the details, Bryan, with us about that. I think that it was an exciting project. Obviously, you haven't done any others since then, but let me ask you this. If the right opportunity came along, would you be opposed to, based on all the challenges that you face, obviously you've learned a lot, you wouldn't make a lot of the same mistakes again, would you take on another conversion project like that one if the opportunity presented itself? We absolutely would. In fact, I came very close to pulling the trigger on another one not that long ago, especially because now, and I shared with your listeners a lot of the things you want to look for that would indicate that, what might make a nice candidate. Mm-hmm. I think there's opportunities to do this all across the country. I'm shocked that it hasn't happened more. Cap rates are so much higher on hotels right now than they are on multifamily that I think there's a lot of opportunity out there that people can pursue. Just keep in mind, you want to check into the code requirements in your local area, and remember that you're going to have to go through a lease up. So you're going to have to carry that property for a while. It's almost, in that respect, it's almost like new construction. At the end of your conversion, you're going to have a big empty apartment building.
I was going to say, do you think, is there an opportunity maybe to where you could get like a variance, like literally, so operate half of it as a hotel and, convert the other half, get the change of use on half of it? That'd be interesting to see if you could approach it from that angle. Probably not. I'm probably stretching that one, but that way you could maintain some revenues while you're doing the conversion. Because you're right. I mean, having a completely vacant building on your hands and then, dumping a bunch of money into it to make it habitable for this new use, that's tough. I mean, just the carrying cost alone, if you don't, I guess, budget accordingly, it could eat you alive, literally eat you alive, and essentially take your business and put it out of business faster than you could ever, in business.
You definitely want to plan accordingly. The one that we looked at closely, one of the appealing things about it is some of the tenants or some of the people who were staying in the hotel were staying long term. So I felt like they were sort of doing an end around on the requirements for hotel stays, but the owner indicated that a lot of them he felt like would rent from us and stay. So that was because he was renting them out as more extended stay, and some of them had apparently been there for quite some time. So there's always opportunities. You can't ever make assumptions, and you just got to dig into these things and figure out where your opportunities are.
Wouldn't there have been an opportunity on this specific deal just to keep it as an extended stay? And then that way you're basically running it like an apartment. If you wanted to market it that way, you're running it like an apartment. It's maybe week by week tenancy, but then you ultimately retain some additional controls that you might not, assuming like an annual lease arrangement. I mean, was that not an option that you explored?
Well, the way he was operating it, I don't think was compliant with code. Right. So you're kind of opening yourself up to get cracked down on. I think in most places you're not supposed to let them stay more than 30 days. Okay. So, and frankly, I could run it sort of like an apartment complex, but I'd still be changing our business model to some extent. And, I try not to chase out too many shiny objects. I do enough of that. So
yeah, that's one of the other questions I want to get out of the way before we finish up the show here is I preach about like focus on, mastering one asset class, not saying that you can't go invest in other types of real estate, but, focus on one, become an expert at it, prove that concept. And then once you've, built a business out of that one focus, then maybe you can pull in another one, right? Maybe we own mobile home parks today. Maybe, I wouldn't say we're on autopilot, but I feel as though we would be quite successful if we said, hey, we want to introduce self-storage to our portfolio or apartment complexes. I've owned lots of different types of real estate. And so I get all those different asset classes, but the first year or two of us buying mobile home parks, it would not have made any sense whatsoever for us to be buying different types of real estate. We need to keep our focus there so we could prove that concept and really master it. There's lots of learning challenges that exist when you dive into any different asset class. And so maybe speak to us a little bit about how you've been able to manage that growth period over these last, 12 years and not feel like you're getting pulled in too many directions, because 50,000 square foot office in the first deal, and then whatever came after that, but you had retail, you had office, and a bunch of multifamily.
Yeah. There are certainly differences, and I can't argue with that. But you know what? There's so many more similarities. And so I think that can't argue with the fact that there's benefits to staying focused. There are fewer things to learn. You're likely to make fewer mistakes, and I've certainly made my share. But, even to this day, we have a lot of staff that work, they're not dedicated to specifically multifamily or retail or office. They're really operated in a very similar way. So I think that in some ways it's been beneficial because we've got those shared resources. And also occasionally we learn something in one asset class that we realize, hey, why isn't that employed over here in this other asset class? Yeah. And it can lead to some innovation. At the same time, if you want to be really efficient and scale, then it becomes a hindrance. Mm-hmm. So, what we were looking at is I wanted to focus on our local market. I wanted to be opportunistic. And when a great deal came along and I had an opportunity to add a lot of value to a property, I was open to any asset class to do that. And now that we've grown quite a bit and we're looking to take things to the next level, I realize, hey, that's a challenge. I mean, people have done that, but they're, especially as we grow geographically, I think it's going to be a lot easier to focus on that one asset class. And that's why we're doing that and excited to take it to the next level with the multifamily.
Yeah, great. I appreciate all that. No, great information there, Bryan. And, every time we have you on the show, it's been the second time, we'll have a third, we'll have a fourth, we'll have a fifth. But every time you come on, every time I'm around you, I get a lot of great information, lots of great ideas. You've obviously been incredibly successful over these last 12 years, and you're continuing to push your company forward and seeing lots of growth and lots of success along the way. And so kudos to you and everyone in your organization, because I know it's not a one-man band. You got a team behind you that helps make this happen. And with that being said, lots of great information you shared. But if you had just one last, I like to call it the golden nugget, right? If you had just one last final golden nugget of advice or wisdom that you could leave with our listeners that might inspire and motivate them as they progress in their commercial real estate investing career, what would that one last golden nugget be?
If I had to pick the one sort of, I guess, strategy that's led to our greatest success, it's really a focus on the value add. And so I would encourage your listeners to get out there and look for ways to add value, but to not go overboard with that, because things have really changed. It wasn't that long ago that people didn't pay for that value add. You paid for what was there. Mm-hmm. And that's sound investing advice to this day. People are now rationalizing higher prices by identifying all the value add ahead of time and paying for it up front. I would say they need to make sure that their properties are going to cash flow, and that if the market does turn south on them, if their properties are cash flowing and they can cover their debt, they're going to be fine. It doesn't matter if the cap rates change, if they can weather the storm with the cash flow. But Go out there, look for ways to add value. Don't overpay, but it's never going to be the perfect time either. So don't be shy and get out there and get started.
No, that's great advice. And just one more point I'd add there, regarding value add, a lot of times if you're getting into a value add project, Bryan mentioned, just make sure that, it can support and service the debt so that you can carry you through the downturn. Who cares if the cap rates go up and your property gets devalued a little bit, as long as it's still cash flowing and you can service the debt. The challenge that I'm starting to see, we'll see how it plays out in the coming years, is folks really get into things that are value add. They're paying for some or a lot of that upside. They're getting more so bridge debt put in place on the front end, not necessarily cash flow. It wouldn't cash flow today with a normal loan in place. And they got to be able to achieve the substantial upside value in a short period of time. And what happens if, whether it's a bridge loan or even like a local or regional type of bank debt that's got a 5-year balloon, but what happens if you can't fully execute that plan, or if there's a slight bump in the market, a downturn in the market, before you can get that new longer, whether it's Fannie debt or Freddie debt or CMBS debt put in place? What is your plan B? Unfortunately, I think we're going to see some of that play out in the coming years, because a lot of folks are stretching, really, really stretching, and they're buying things on tomorrow's value, and the debt they're putting in place isn't the best debt to help you actually weather that downturn. So I don't know if you've got any thoughts on that, Bryan, but I guess we'll just have to wait and see. I'm surely not a magician, and I don't have a crystal ball, but I'm watching things get sold in our space, in the mobile home park space, that I literally can't make sense of at all. And I feel like I know the niche pretty well, but there's always smarter people than us. That's what I like to say.
Yeah, no, there's definitely, I think people are wise to use caution right now.
Yeah.
As we've looked at possibly syndicating some deals, and I've been looking at things at other regions of the country as well. And it's a very, very frothy market right now, and people are paying for all that value add up front, and they're not leaving themselves any room. And if you have exposure and your rates are going to reset for some reason because of your financing structure, like you mentioned, that could, there's going to be some prices to pay if that ever worst case scenario ever plays out. So that said, we can still find great deals, and people just need to be persistent. The change of use we talked about today is a great example. But if there's no substitute for rolling up your sleeves and working hard to find those deals, and be patient, and they'll come.
Yeah,
if you
absolutely.
Work hard enough, they're there.
I agree. You got to put in the the sweat equity, they say. Put your work in, and I feel like today you have to hustle a little harder, but that's okay. What I like to say is that if you can get very good and hustle at finding, uncovering opportunities and identifying opportunities where others don't, in a more aggressive buyer's market like we're in today, then if things do take a shift to where it becomes more of a seller's market, then you should be able to clean up shop.
Yeah, absolutely.
So with that being said, Bryan, really appreciate you coming back on. It's always a pleasure to talk with you. Folks, if you'd like to learn more about Bryan and his company, you can go visit his website at WashingtonStreetProperties.com. Again, WashingtonStreetProperties.com. And Bryan, that's all we have, my friend. Always a pleasure having you on, and look forward to staying in touch with you.
Thanks so much, Kevin. I appreciate it.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com, and we'll see you next Monday morning.